Hey everybody, Day Trader Rockstar here. And the first video of the series I want to really talk about is setting up your charts. When you go to work and when we're going to apply these techniques, you got to have your charts set up perfectly. Something with charts, I started, again, with over 25 years of trading. I've tried a lot of different charts, experimented and used some went out of business. But I've always been a big fan of Jerry Medved's quote tracker, and that got bought by Ameritrade, and he then put out Medved Trader, and basically the same thing as quote tracker. If I go to the site fast, you could let's just kind of show you where it is. It's Medved Trader, it's called. It's very reasonable. I think it's $24 a month, or you get the annual $239. You have to go or use the free one. It's just you have to find some good charting service. So what's good about this is it connects to a lot of brokers. You could trade through this setup. And again, this is something out of a habit for me. Some people are going to be using other charts. It doesn't really matter as long as you find something that you're happy with and that it works for you. Once you start to use something, you tend to adapt it pretty fast, and you won't want to change from it because change is hard in this game. So this is my quote tracker. Feel free. I have a template that I give out, so if you use quote tracker, just send me an email. I could send you the template, and it'll load all these indicators on for you automatically. But if you want to do it yourself, these are the ones I have on here. And every one of these indicators play a part in the methodology, especially the stochastics, which there are actually 3 right here. But the other lines and the candlesticks, there's all different ways of trading. There's hundreds and maybe even thousands of indicators out there. All right, so let's just talk about our moving averages first. That becomes very simple. You have 2 moving averages. You have the exponential and the simple moving average. I use the exponential moving average. All right, some people like to use the simple. When it comes down to it, you can see a trend holds moving averages really well. A lot of algorithms work off of it. It's important to have it on your chart to identify trend, maybe to help you out. So the 20, which is green, 50 is blue, and my red is always the 200 period moving average. Now we have a salmon colored or light magenta type of purple down here. This is the VWAP. The VWAP here measures the volume weighted average based on price and volume, basically, and it plots this line and it restarts every new trading session. And it's just a fantastic indicator to have on your chart. You'll see that the price tends to when it comes into play and the price comes into play, usually the first time, we usually see it hold up, causing a good area to trade off of, either support or resistance. I think it's one of the stronger lines out there. Of course, if you have a very bullish day, you're going to see a trend away from it, but lots of times you'll come back to it. Same thing on a negative day, you'll see a trend down to it. But on choppy days, you tend to watch that. I tend to watch this. It's a very strong line. That's the color I keep it. So those are the 3 lines, kind of the 4 moving average type of lines that you'll see on the screen. The lines we see are horizontal lines, and these really represent what I call the previous day's high and low, open and close. So the previous day is very important. So when you have a candlestick and you have a daily candlestick, that candlestick's identifying the high of the candle and the low of the candle, or that basic range of the day. When you trade in a new day, it's very important to where the previous day's high and low is, because those become more technically an indicator once you start breaking through these candles. So if I zoom in on this candle here just a little, just to kind of you want to watch that. Now this is on the 1 minute time frame, so it's not the same, but we still are able to, I see here's the previous close, there's the main pivot, and we'll talk about that in a second. So lots of indicators. If I pull down my indicator list here, or I could maybe right click on this and add edit indicators. You'll just go down here. You see all the indicators you have. I mean, you could experiment with a lot of these, but I'm setting a very good method here, so I don't try to complicate things too much. It really comes down to stochastics. The other lines up here are just kind of to kind of pad a setup, or just give me some extra, extra knowledge of the markets. All right, so we got those lines in: previous close, previous close. The volume is there. It's not. It's probably low on the list. You don't even really need it. I like to, of course, like to see the volume in case there's some news. You can usually tell if there's a lot of volume hitting the markets. Not just mention that the price is going to move, but you want that correlation between price and volume. So I always keep it. It's a small little window, but the stochastic is probably going to be the most important thing on your charts. And I usually kind of give it enough room. I can make these a little bit bigger. If you're using this platform, that's great. Like I said, I have a template I can just give you, and it'll set up your charts exactly like these. All right. The next up, we have the volume, and the volume is important. Just a decent volume spike with price usually means news. I keep this window a little bit small. It's not the most important indicator on my list. The most important indicators on my list are the next down here. These are the stochastic oscillators. And I usually have 4 bands here, and I'm going to put the 4th band in here just to show you how to set those up properly. So again, I try to keep these color a little bit different. I just have the 9-3 as a red, green, and blue, and I just so that it's easy to read. Typically with stochastics, if I scroll over, you can see there's 2 lines. There's a percentage K line and a percentage D line. And I only use the percentage D line, which is what we call the signal line, and it's a moving average that's placed over the K line, so it smooths it out a lot. As you can see, the other line is very choppy, and it goes all over the place, and it's usually very hard to read versus the other line, which is a little bit smoother. So how do we just show that percentage K line or percentage D line in this case? Well, I'm going to show you that. So all of them are just showing percentage D, even though stochastics come out with 2 lines. It is important to understand that we're only using 1 line here. We're not using any type of crossover technique or method. We're just doing divergence right now. So if you're using the Medved, what you're going to do is you're going to right click, you're going to go to indicators, and you're going to go down to your fast stochastic. I think there's two different type of things here. Just scroll all the way down. You'll eventually find it. Click on the fast and just push it over there, and then you're going to edit it. So we'll go to the editing table, and these are all the other indicators I have. So if you're using the quote tracker or the Medved Trader, then you can actually see what I have here. I want to make this 40. And you can just put your 40 in there. I'll just roll it up here. And this is going to be 4. And I'm not going to go into the reasons on the 44 right now, but just remember that's what that is. And it's a fast stochastic 44. I'm not going to show a band. And when we look at these, if I say OK, let's see, and we apply that, you're going to see that pop down here. You can see this is what the normal stochastics are looking like. And very choppy. We're not really seeing much. I can't really tell much from that, especially if you're, so what I'm going to do is now I'm going to show you how to get rid of one of those lines. So the signal line, it says it's labeled signal. That's your D line. Your other line is your period back line or your K percentage K line. And that's blue. So I want to go to my colors here. I'm going to go to clear over here. And I want to make my signal line a little bit thicker too. I'll make that a 2, and I'm going to change the color so I don't get confused. So I have blue. I don't have. Well, I do have. I can make this blue actually. Let's see what it looks like. There we go. All right, so I have the blue lines, kind of similar to the 60-10. In lengthwise, the longer the stochastic, the K figure, the longer that, or the bigger that number is, the more slower the line will be. Versus if it's fast, it'll be very back and forth, back and forth, back and forth. But I always keep the fastest to the slowest. So my 40 should be above the 60. 60 should be on the bottom. 40 should be right above it. So we're going to fix that. And again, I think we just go to our indicators here. And we'll go to the stochastic indicators right now, and we'll see if we can move this up. I'm not exactly sure. Oh, I think we can move it up, right? There we go. Apply. And then boom, there we have it. From these 4 indicators, we have 3 of our main trade setups. All right. The standard divergence setup, where we have, say, a low right here. I could spot divergence like anything here. A little low. The market pops, it pops back up. The price comes down, takes out those lows right here, as you can see. This is when it happens right here. Actually, I don't want that there, sorry. So you have that lower low and then higher low. It's really the only time you're going to get the setup is when the setup is there. It's just nothing more about it. And you can see actually this was kind of a little pullback in an upward trend. And that's what a divergence like this is great with the upward trends, because they're little pullbacks that give you a great opportunity to get in. And this is 1 o'clock in the morning. Not that we're looking at that at 1 o'clock in the morning, but I'm just showing you the 3 setups you're going to get from this. So you're going to have a regular divergence using stochastics. With the 4 bands here, we're going to also have what's called a quad rotation. And a quad rotation is if you're watching the market gyrate up and down in a bigger trend. Again, we're looking at a 1-minute time frame. So we're measuring all these together. And we would like to see them come all up at the same time and all down. And when I say all down, they all have to be underneath the 20 line here. 20 underline, this one's not, just that didn't qualify. But if they all come down under the 20 line, and you can actually see the 20 right above the line, like right here and right here, right here, that line, when that happens only a few spots, that's called our quad rotation. We tend to get a bounce there. Now, that's something that took years and years of developing the different bands and stuff and seeing the timing. When it comes down to the 60-10 is actually in sync with the 5-minute time frame. So it's like having a 9-3 stochastic on a 5-minute is having a 60-10 on the 1-minute. So I'm able to look at this band right now and automatically see what the 5-minute is and see what the 1-minute is. So if I know that this is down here oversold, that means our 5-minute is oversold and we have a bigger chance for a bigger rally. Here's another chance that it comes back down and it'll all get underneath this level at the same time. And it only lasts, it's not, foolproof, because if the market goes into a free fall or has some really negative news, you have to identify that. If it's in a kind of a nice little channel or just kind of a choppy consolidation and there's no trend to it, these work great. And it just gives you that opportunity right around here, for that bounce. And again, you had the same thing. Look at the big bounces. Now, why does that happen? Well, it's just something that I've studied so many, for so much, and then they're able to identify that. Here's a nice divergence and a quad rotation. So here's your divergence, oversold, and this is right on the oversold level. I can see that. Again, my key is to have that little dotted line above the stochastics there. And this being a divergence, it's perfect. And these are the moves. These are our trades. These are our $20 trades. These are where we want to be in. Now, I'm not going to be in at 5 o'clock or maybe 4 o'clock, but maybe you are. And this is what you need to just concentrate on. Do not stray from this. Another beautiful divergence here is what I call almost a hitting divergence, because it's so strong. The fast move down, and then look at the big move after that. All right, that's the second setup you're going to see. And the third setup, and again, I would have to see if I see it there, but typically we call it the 2020 bull flag, and it happens in the trending markets. When you have a really good trending market like this is a good example. This would be a pretty good example here. You're looking for the situation kind of right here. You have a trending market that pulls off and the price comes back down. Now the price, we watch that 20-period moving average, we watch the fast stochastic, we watch the slow stochastic. This is kind of under 80. What we want to have is the slow stochastic or 60-10 above. And again, there'll be individual videos on this, but this is the type of setup I look for all 4. One comes back, rotates fast. One holds, the 5 minutes holding very strong trend. And this holds above the 20-period moving average. You go long on the close above the 20. on this type of move. Once it gets oversold and this is embedded and the price closes back above the 20, that is called our 2020 bull flag. So you have the 2020 bear flag also. All right, but it's very important to have the 60-10 embedded. When the 60-10 is embedded up here, just like here we go again. We get oversold. We have a pullback, close above the 50, and then it has a nice little follow through. And it has to look, this is important of a flag. A flag has to have a flagpole. A flagpole is an aggressive move higher. And that aggressive move usually pulls us away from the 20-period moving average. And then we drift back down into it, and we get oversold quickly on our 9-3, but we stay strong on our 60-10, which represents our 5-minute, knowing the bigger trend is strong. So this is golden for this. So that's our... So we have what do we have? We have the divergence, we have the quad rotation, and we have the 2020 bull flag. That's why we use all 4 bands. And that's all we do, is wait for those setups. Nice little pullback channel here, a lower low, kind of a, no divergence there, but a channel. And this is what this is what I do. This is my job, is to identify these things and always go through the markets and let you know when the good spots to trade are. So I hope you enjoyed that video on how to set up your charts. If you have any questions, we're going to use the videos as our forum to go back and forth. So please leave your question in the video comments and I'll answer them there. Make sure you subscribe to the channel, because this is a whole new channel based off of this methodology, and it's important to subscribe to it and make sure you don't miss any of the videos, and like it. That would help. Thank you. Alright, so let's move on. Next video in the series will be coming up probably on Tuesday. And if you want to watch this show, let's not forget, daytradingradio.com. Trading live every day, daytradingradio.com. We get in the markets around 7:30, 7:45. We trade all the way to 4, and some nights we do overnight trades. So hope to see you there. That's at daytradingradio.com.